For Morningstar, I'm Jeremy Glazer. We got a few pieces of potentially interesting economic data this week, and I'm here with Bob Johnson. He's our Director of Economic Analysis for his take. Bob, thanks for joining me.
Great to be here today.
Let's start with the Fed minutes. Obviously, when the Federal Reserve is going to raise rates has been a hot question or a top question for a lot of investors. Did we learn anything from the minutes of the January meeting?
Well, there are a bunch of very different aspects of it. I think that a lot of focus was on that there was no hurry to raise rates is what people took away from the minutes. And their primary basis for that, there was talk in there where they used the adjective many committee members felt that raising rates too soon could be harmful to the economy. And then the category about, well, but inflation's a big worry too. That just had the word several in front of it. So the fact that many is bigger than several seemed to indicate the Fed is kind of on hold for rates right now.
Did they or anything else in there that seemed interesting in terms of are they worried about inflation?
Yeah. They're very focused on inflation right now, and they're afraid of sending the wrong signal, and they're a little afraid of, well, what happens if inflation's kind of low and we want to raise rates? And so they're really focused on the inflation data, and they're like, well, should we include energy? Should we not include energy when we think about this? They're also looking at, well, gee, do we use surveys of people and what they think about inflation, which says that, everybody thinks we're going to return to kind of this 2% normal inflation level, which is just where we want them to be. But then you look at the data based on the TIPS, the inflation-adjusted securities the government issues, and look at that. It implies a much lower rate of inflation, which has got some of them worried, and they're kind of having a big argument in the notes about, well, which one's the right one. So there's a lot of little interesting tidbits like that in there. And I guess the third thing that was interesting to me is even though they seem to indicate, well, let's put this off a little bit, was kind of the implied language. There was an awful lot of lineage in the actual minutes about, well, when we do change, how do we announce it? Do we announce multiple steps? Do we announce it here? How do we do it? And the mechanics of announcing it. And if it was really far away, I don't think they'd be arguing about the mechanics of how we announce it. So I think it looks like there's something this year, but I'm still thinking it's going to be later in the year than earlier in the year. But many people disagree with me on that.
But if it's earlier or if it's later, does that have a big impact, at least on an individual investor?
No. I mean, I think the short-term rates need to be about where inflation is. And right now it's pretty low. I mean, it's probably about 1%, but the Fed funds rate is still under that. I think the rates need to approach each other to be a normal economy. And at some point, it's going to adjust. And whether it's in June or whether it's in September, I think we have to equalize at some point. They can't do this artificial thing for too long, or eventually the buyers in the market will kind of figure it out and they'll bet against it anyway.
You don't seem that concerned about if it's June or September. Why is the market so fixated on the exact timing then?
The market is very fixated because the day they actually announce the rates going up, it's probably going to be a very bad day in the market. We could be down 5%, 10% in a day. We could see dislocations in the bond market. We could see a hedge fund caught in the wrong position and cause some type of financial distress. So that's why everybody's so worried about the exact day. But again, if we've looked at the other times they've changed things, we've had these short-term impacts, and then we just kind of go back to normal again. So I don't want to be the day trader out there who's probably going to get massacred one way or another when they do this. But instead, I'm focusing on the longer term and that higher rates are necessary to bring us back to normal. The last time we actually moved rates a little bit higher in the so-called taper tantrum, when rates went up, it actually caused a big boom in the housing industry because everybody rushed out to beat any more rate increases. So. And then you've got the older people and retirees that want more money on their savings. And certainly it's going to help in that category. So I don't view a short-term move in rates as going to destroy things.
Let's turn to industrial production. Those numbers highly impacted by what's happening in energy. What's your take on it?
Yeah. First of all, I want to strip out and look at the manufacturing part of it. I don't want to really look at utilities, and I don't want to look directly at the mining industry. And the industrial production figures were up 0.2% in January. That annualizes it to about 2.2%. We've been running 4 or 5%. So the numbers were disappointing, even kind of when you toss out some of the categories I mentioned. So it's clearly we've gone into a slower environment there. And energy is an important part of the index here. And I think it's what's happening is drilling equipment part of it was actually down 10% in this month's report. So really pretty dramatic number. Where gasoline and things like businesses and consumers buy held their own, and the actual production of oil was off just a teens.
What's your forecast then for manufacturing in 2015? It will be difficult to repeat the success of last year?
Yeah, 2014 was a great year for manufacturing. We got close to 5% year-over-year type of numbers. So that's really a stellar performance, especially so far into an economic recovery. This year, we've got a lot of factors working against us. We've got the strong dollar is going to affect exports. We've got a slowing commodity market, and that means less commodity mining equipment. So that's going to be a slow market probably yet for us in 2015. So you've got a number of factors. And then you've got the whole energy sector kind of just beginning to slow up. All of those things will pull down the industrial production number. And I think we're probably going to end up the year more like 3% instead of the 4 to 5% that we've been used to.
Finally, we got some housing data this week. Any signs that there's a better recovery in that sector?
You know, unfortunately not yet. I mean, I think the numbers weren't awful, but we were down in starts and permits January compared to December. Some of that is obviously probably weather-related. We saw a big dip in the Midwest numbers. So, but that's not the entire story. But nevertheless, housing is not booming, and permits is something, you know, you don't have to put a shovel in the ground. So those kind of hold up a little better than starts usually. But we really didn't see the permits number look good, which means it's going to be hard for the housing recovery to get much better until at least kind of March or April, unfortunately. And certainly one of the areas of strength has been the multifamily sector, which actually did show some improvement from December. So that was one bit of good news.
Bob, thanks for the updates today.
Thank you.
From Morningstar, I'm Jeremy Glazer. Thanks for watching.